The Nasdaq 100 index is arguably the second most popular index in the world, with the most popular being the S&P 500 index, of course. That's because while the S&P 500 was able to give an annualized 10% return over the long term, the Nasdaq 100 index has managed to give a much higher 15 to 17% annualized return over the long term. So, in this video, I'll be sharing everything you need to know about the Nasdaq 100 index, such as what exactly is this index, which ETF can you invest in, hint, it might not be QQQ, and finally, I will share my thoughts on whether it's a good idea to invest in this index or not. Also, do join my Telegram chat group to discuss personal finance or ask any questions that you may have. Alright, let's jump right in. The Nasdaq 100 index is a collection of the 100 largest, most actively traded companies listed on the Nasdaq Stock Exchange. So you have companies like Apple, Microsoft, Amazon, Tesla, and just the top 10 companies alone make up almost 45% of the entire index. But contrary to popular belief, the Nasdaq 100 index doesn't just hold tech companies. Instead, technology only takes up about 57% of the index. Then you have a few other sectors such as consumer discretionary, healthcare, telecommunications, and so on. But most notably, this index doesn't contain any companies from the financial sector, such as commercial and investment banks. So, because the Nasdaq 100 index is a lot more concentrated on tech, and thanks to the recent AI boom, many of the tech companies were able to deliver some fantastic returns over the past few years. As a result, the Nasdaq 100 index was able to almost always outperform the S&P 500 in terms of returns, company revenue, earnings, and dividends. However, this may soon come with its own downsides, which I will talk about later. For now, let's talk about which ETF you can use to invest into the Nasdaq 100 index. Oh, I know, you can invest in QQQ. Hold up, because it's not so straightforward. Check this out. Here, we have a few ETFs that let you invest in the Nasdaq 100 index. There are actually a lot more ETFs out there, but we will only be focusing on the more popular ones that's denominated in US dollars. Here, we have two ETFs that are domiciled in the US, and two that are domiciled in Ireland. But you may be wondering, why are we even looking at the Ireland domiciled ETFs at all? Can't we just focus on the ETFs from the US, the land of the free? Short answer, tax implications. If you are from a country that doesn't have a tax treaty with the US, like Singapore, there's a 30% dividend withholding tax, meaning you will instantly lose 30% of the dividend money whenever there's a dividend payout. So to avoid this issue, one solution is to invest in Ireland domiciled ETFs instead, where there will be a much lower 15% dividend withholding tax. However, before you go, oh, in that case, let's invest in Ireland domiciled ETFs. You need to understand that the downside of investing in Ireland domiciled ETFs is that they have a higher expense ratio of around 0.3 to 0.33% as compared to US domiciled ETFs, where the expense ratio are lower. So let's find out which ETF charges a lower overall fee. Here, I'm calculating how much tax there is on dividends. Okay, while the Ireland domiciled ETFs don't have a dividend yield, there are still dividends. In this case, the ETFs are accumulating funds, meaning instead of paying out dividends, they will just automatically reinvest the dividends. However, the reinvested dividends will still be subjected to the withholding tax, So I will just assume that the dividend yield is the same as the dividend yield of QQQ. Then, if we sum out the expense ratio and dividends tax, we can see that the total fees for US domiciled ETFs are lower than the total fees for Ireland domiciled ETFs. This means that because the dividend yield for the Nasdaq 100 index is quite low, it's actually cheaper to just stick to the US domiciled ETFs. Quick pause. There are a ton of ETFs that you can choose from, and sometimes it may be hard to decide which ETF you should go for. With Momo Singapore, you can easily look for the ETFs that you want to invest in, as Momo Singapore has a detailed and comprehensive classification of ETFs. Though, just take note that investing may not be suitable for all investors, so you need to carefully consider the risk involved before investing, But let's say you do decide to invest in US ETFs. You can open up the Momo Singapore app, head to Markets, go to US tab, tap on ETFs. You will find different criteria which can help you filter out the ETFs that you want. Let's try the North America ETF. Then sort by trading volume to find the most popular ETFs in the market. If we ignore the leveraged ETFs, we will see SPY, which tracks S&P 500 index, and QQQ, which tracks the Nasdaq 100 index. Or maybe you are interested in industry or sector ETFs. In that case, you can tap on Industry ETF to get a list of industry-specific ETFs that you can invest in. Moomoo Singapore also provides you with free Level 2 market data for US stocks and ETFs. This will give you insights into a stock's price action, which may help you further in analyzing stock movements. Right now, Moomoo Singapore is offering some very generous sign-up promotions. If you sign up using my link down below, you will get to enjoy 5.8% per annum guaranteed returns for up to 30 days on your first $80,000 invested with Moomoo Cash Plus. However, just take note that Moomoo Cash Plus is an investment product, yeah? So, the principal is not guaranteed, and the 5.8% per annum rate is only guaranteed during the 30 days promotional period. After the promotional period, interest is not guaranteed. This is not comparable and is different from a fixed deposit or savings deposit. Investment in any capital market products such as money market funds involves risk and the risk to lose principal. Besides Moomoo Cash Plus, if you deposit $10,000 and perform 8 buy trades, you can get 4 stock bundles worth $280 in total, with each bundle consisting of 5 fractional US stocks such as Nvidia, Tesla, Apple, C, and NIO. What's more, you can also get up to 20 SGD cash coupons after depositing 100 SGD and performing 1 buy trade. So that's around 680 SGD worth of welcome rewards in total. So if you're interested in taking your investments to the next level, do try out Moomoo Singapore. For more details of the promotions, refer to the link landing page in the description below. And with that being said, let's get back to the video. But then, why are we even looking at Ireland domiciled ETFs? That's because of the second tax implication, estate tax. Estate tax is when you are investing in US securities and you suddenly pass away, touch wood. If you have more than 60k worth of investments, your investments will be taxed anywhere from 18% all the way to 40%. Oh, sorry, not your investments, it's your descendants' investments now. So that will be your main reason for investing in Ireland domiciled ETFs, which is to avoid estate tax. Then there's also another tax implication called capital gains tax, where if you sell your investments and you make money, the government will tax your profits. Fortunately, in many countries like Singapore, there are no capital gains tax, so we can ignore that here. Now, let's say you decide to invest in an US domiciled ETF. Is it better to invest in QQQ or QQQM? But first, why are there even 2 ETFs? That's because Invesco, the company behind the fund, wanted to offer a cheaper alternative to QQQ. So as you have seen earlier, QQQM has a slightly lower expense ratio of 0.15% as compared to QQQ's 0.2%. But why not just lower the expense ratio on QQQ? To put it simply, money. With almost $220 billion asset under management and a 0.2% expense ratio, QQQ is generating around $440 million of annual revenue on QQQ. Why would they want to reduce the expense ratio when they could just leave it as it is?
Don't make sense leh.
However, with more and more ETFs offering lower and lower fees, Invesco decided to launch QQQM back in 2020 in order to stay competitive while not giving up on its QQQ cash cow. As to whether you should invest in QQQ or QQQM, it depends on why you are investing in it in the first place. If you are planning to use it for trading, like in out every day, then QQQ would be a better choice. That's because QQQ has a high average trading volume of 51 million as compared to QQQM's trading volume of just 1.5 million. This makes QQQ's bid-ask spread sibei tight as compared to QQQM's bid-ask spread, which is a little wider. However, if you are planning to invest in it over the long term, then QQQM would be a better choice. That's because even with just a tiny 0.05% difference in expense ratio, it can make a huge difference over the long term. So let's say I'm investing $10,000 into both funds and both of them give a 10% rate of return for 10 years. After 10 years, my QQQ would be worth $25,423, whereas my QQQM would be worth a little more at $25,500. In total, I would have paid $330 in total cost to QQQ as compared to $248 to QQQM. Remember, this is just by investing $10,000. If you are investing a lot more, like $100,000 over 20 years, the difference in final value and total cost would be a lot bigger. So, in short, go for Ireland domiciled ETFs if you are worried about estate tax. Otherwise, just go for US domiciled ETFs. If you are using it for trading, go for QQQ as the bid-ask spread is a lot tighter. Otherwise, go for QQQM if you're investing over the long term. So simple. But now, I guess the question is, can you go all in into the Nasdaq 100 index and ignore all other stuff like the S&P 500 and so on? Can is can, but it depends a lot on your risk tolerance. While the Nasdaq 100 has gone up by a lot, it can also fall by a lot. Then you can say, I didn't sell when the Nasdaq 100 dropped by 27% back in 2020. And I also held on when it dropped by 33% in 2022.
Easy peasy.
That's actually just a tiny crash, yeah. If you want to see what's a real crash, you can check out the dot-com bubble crash, where the Nasdaq 100 index has lost almost 80% in over 2 years. After that, it took almost 15 years for it to recover back to its previous high. There's plenty of time for you to paper hand, yeah. Another thing to consider is that industries come and go all the time. For example, in the 1970s, the US was dominated by a lot of industrial companies. Then in the early 2000s, it was financial companies. And now, tech companies. So by just focusing mainly on QQQ, which is tech heavy, you might be missing out on growth opportunities from the other sectors. That's why for me personally, I would prefer not to just focus on the Nasdaq 100. Instead, I would try to diversify a little by adding in the S&P 500 index into my portfolio, so that when times are good, the Nasdaq 100 will help to deliver higher returns, and when times are bad, the S&P 500 is there to reduce losses. Best of both worlds. Anyway, that's all for this video. Hopefully you found it useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.